This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Tuesday morning. We are coming to you live from the CNBC TV18 Motilal Oswal studios, and I'm Prashant. With me, my colleague Nigel here is in the studios. Nigel, hi, morning.
Morning.
Sonia is, of course, joining us from Bangalore. Sonia, morning.
Hi, Nigel. Hi, Prashant. Good morning. For the markets, it's been very, very range-bound, right? Not too much happening, and I guess that recent high that we saw, 19,500, is becoming a little bit of a sticky zone for the market now, Prashant.
It seems to be, Sonia, and let's actually kick off on that exact point, what you made. Yesterday, the Nifty basically got to the near-term resistance level, which is 19,400. Now, that is nothing but the point where the Nifty meets the nearest, smallest trend line, falling trend line. We put this level out in the morning yesterday as well. We closed just 7 points short of it. Intraday, there was a breach of the 19,400 level twice. So intraday, it looked good. It cleared, but closed, it fell short by just a little bit. But you basically practically closed there, which is great news, right? It's not a bad way to start a Monday, start a new week after the last few days, which looked very, very iffy. That's point number one. I'll circle back to levels in just a bit. Just take a quick look at what the global setup looks like. Equities rallied. So you had the US S&P, which was up about 0.6. The Nasdaq was up even better with a 1.5% plus kind of gain. But along with equities, what also rallied were Treasury yields. Now, this has been the big story that we pointed out. Yesterday, for example, same time we asked the question, the market seems to be hunting for what is the neutral rate, the rate at which the Fed will no longer have to do more or cut. Kind of leave rates at that particular level. What is that level? That seems to be the confusion the market seems to have. So if you look at what happened, the 2-year is now at 5%. These are all nominal values. The 10-year jumped 9 basis points to 4.3%. This is the highest since late 2022. That's on the 10-year. Actually, you look at longer maturities like 30-year, they're also hitting records now. The question is only this: rising yields also signal growth, which is good, right? But this is also what you describe as the risk-free rate. So at this rate, can things function well, especially risky assets like equities function well? That's the only question. I reckon that we are in a bit of a transition period. The market is adjusting from what it thought it will get, which is a soft landing, to maybe something else. We will find out. And to that end, the Jackson Hole sort of meeting, which kicks off this week, is going to be important in kind of setting that context. So the primary risk now becomes that the market interprets what comes out of Jackson Hole in a hawkish way. And looking at the Treasury market reaction, the bar for a hawkish surprise seems to be lower, not higher. You had the Fed Chair Powell, who will speak on Friday. And I think if he does indicate that maybe the neutral rate, where they will feel comfortable leaving rates at for a while, is higher, I think the market perhaps is already there. It's kind of adjusting itself in anticipation of it, or maybe we see a little bit more. So that's the global context. It's a question of whether, in what shape or form will growth have to be slowed down for inflation to be brought under control. That's as simple as that. Now, let's just get back to the Nifty. As I said, 19,400 is the first level. It needs to keep its head above the 19,400 level, point number one. The next hurdle on the Nifty is the 20-day moving average, which is at 19,554. So once, you cross this, another 150 points, you're at the 20-day moving average, which is, of course, well discussed. On the way down, the low of 19,253 should not be broken. So that's basically the low from last week, which the market got to. Now, Bank Nifty, broke, and it looks like, yesterday was a decent kind of price action. We ended about 1/3% higher, but closing above 44,100 on the Bank Nifty, which is another 100 points from here, will indicate that perhaps the pullback, which is the short-term correction that we have been seeing, is complete. But that is only the first marker. But you need markers when you are undergoing a short-term correction in an otherwise uptrend. On the downside for the Nifty Bank, the level to watch is 43,600, and that is the important level which the Bank Nifty better defend if selling were to start to emerge. As I said, I mean, it's a bit of a range right now with no clear direction. Yesterday, we had a similar kind of implied open from the GIFT Nifty, but the market picked up and ended up in a very smart way. So maybe we see, some a semblance of what we saw yesterday, today as well. After all, it's not as if, there is a growth problem, right? Not here in India or the big market in the US. But it's just, that perhaps in the US especially, there is a little too much growth for markets liking. But that's not a terrible problem to have. It's a problem which needs a solution, but that is what it is. Sonia, so it's an interesting setup as we begin this Tuesday.
I think it's a great problem to have, right? Too much growth. Of course, from an interest rate standpoint, things are different, but growth is always a good thing, and the benchmark of every bull market is based on growth, earnings growth, corporate growth, etc. So having said that, Prashant, as you rightly said, this is a market that's so range bound, but within that there are pockets that are doing well, pockets that are seeing profit taking. So that's important to point out. So while the Nifty is within this band of 19,200 to 19,500, this month, IT, for example, has done very well, whether it's Tech Mahindra, HCL Tech Infosys, all up about 3 to 10% this month. And on the flip side, auto stocks are coming off a little bit. So this month, autos have been the biggest loser. So within this range as well, there's lots happening in individual names. The recent high of 19,480, it's a bit of a sticky zone on the upside. And there seems to be no major trigger on the horizon which can take the markets above that level. So in that context, perhaps this range is something that we'll have to reckon with. As you said, multi-year high for the US 10-year yield, 4.34% now. And I think this is the highest level that we've seen since way back in, 2007. And that has led to, because of the higher US yields, that's put pressure on a lot of commodities, whether it's gold prices, which are at a 5-month low, silver prices as well. Brent is back at $84 a barrel. So important to, put that into context. There was a large FII sell figure yesterday, despite the market holding on to that 19,300 mark. The FII sold 1,900 crores in the cash markets, while domestic institutions bought about 620 odd crores. And a couple of data points that I'm watching out for from the global arena. One of them is the Fed non-manufacturing survey. There's the US existing home sales data that comes out today. And then, of course, there's Fed Chair Jerome Powell's speech that happens on Friday. Generally, it's not very market moving, especially here in India, but we track it nevertheless to get any cues on what the Fed might do going ahead. But Nigel, as I was pointing out, the market might be range bound, but within that, the constituents are very interesting, whether it's technology stocks that have come back in a big way, or even, autos that have started to cool off a bit.
Well, Sona, you just take a look at the mid-cap index. The mid-cap index on a day-to-day basis, you're finding stocks that are moving up 5 to 10% in a single trading session. So that's really where the big action is. Even yesterday, the mid-cap index was quite strong, ended higher with a solid gain. But yesterday, we made this point, right? That it's a bit of a scalper's market. What is that? You buy the intraday dip, but you don't carry the position. Now, if you did that yesterday, you didn't miss out anything today. Because for starters, we're likely to be more or less flattish. In fact, we came off a little bit from the day's high. So the Nifty is still in this 400-point range odd. But the Nifty bank, that holds the key. And that will give direction. Either it goes ahead and revisits the 43,600 odd mark, which we touched last week, or it starts moving towards 44,700 odd. We'll get to those levels and why I'm talking about those levels in just a bit. Yesterday, there was clearly some kind of unwinding of positions, and it appears, at least from the FIs, there was some kind of short covering on the Nifty bank, and that's been the weaker index. So there were first signs of some short covering. On the index futures on the whole, well, they continue to remain net short with close to around 57% of their positions on the short side. What's heartening from the F&O perspective from the FIs? Well, it's the way they wrote puts yesterday. Close to around 2 lakh puts were written. More than 2 puts were written for every 1 call. So that's giving you a sense, maybe in the near term, the bulls believe the lower levels can get defended, at least going by the options data. 2 strikes I'm pulling up. On the Nifty, that's a 19,350 put, 19,500 call. And both of them, you just take the premiums and you fit it into the levels that we're looking at, and it fits in perfectly. On the Nifty, the 19,550 odd mark, that's the 20-year DMA. So that becomes a bit of a resistance zone, and we'll be in this band till we decisively cross that. On the downside, well, the 50 DMA comes in closer to around 19,300. But as we have seen over the last few days, 19,200, 19,250, it seems as of now, positioning is such that we don't break that level on the downside. But the Nifty bank, there appears there was some writing even at those strikes, 44,000 put, 43,900 put. So getting straight to the levels then, just going by that put writing that we've seen, The 100 DMA is at around the 43,740 odd. So this support actually is at around 43,600 because we tested that last week. On the upside, 44,200 becomes a resistance, first level of resistance. The 44,000 call has the highest amount of open interest. So I'm just plugging in the premium out there. And the second resistance comes in at around that 44,700 odd crucial technical level. Since it's the Nifty Financial Services Index expiry, the weekly expiry, just will put that band as well up for you. The gift Nifty is suggesting a flattish start, but I think you stick to the trend. If you get a big intraday dip, maybe you look to buy that and you square off your position without carrying it to the next day. But we are still pretty much in a consolidation mode.
Okay, well, lots to focus on in the next 2.5 hours. So let's get started very quickly. We have some commentary first up coming in from Vikas Jain of CLSA. He's quite bullish on the Indian markets. He says that consensus upgraded its Nifty FY24-25 EPS by 0.6 to 1%. Okay, but they are actually 3 to 5% below consensus. He says despite a greater number of stocks seeing earnings upgrades than cuts, CLSA analysts have cut their recommendations for a far larger 14 stocks versus upgrades for only 2, suggesting discomfort with valuations. The impact of the sharp increase in inflation on rural demand will need to be closely monitored, he says.
Okay, we've got Venugopal Gare of Bernstein who says that India is at a crucial juncture regarding the state of the economic cycle. He says good policy and strong execution will give India a significant economic opportunity. He adds, while it's still early days, their engagement with key policymakers suggests a similar perspective, suggesting that India's story is being approached in a more organized fashion at the highest levels of the government. He remains optimistic about India's long-term prospects.
All right, let's also get you some money market views for today. Abhishek Goenka of IFA Global says the recent weakness in the rupee can mostly be attributed to the sell-off in the Chinese yuan. However, he says the RBI has so far managed to prevent the rupee from hitting new all-time lows against the dollar in onshore spot. He says domestic July CPI overshoot, higher crude prices and higher US Treasury yields too are contributing to the rupee weakness. He expects the RBI to continue to step in to curb volatility and revises their medium-term range to 82.4 to 83.70 to the dollar.
On bonds, we have Ajay Magnolia of JM Financial who says that global yields remain elevated as fear of higher for longer policy rates in major economies continues as they display resilient economic data. He says domestic yields may take cues from US Treasuries, crude prices, US PMI data, as well as Fed Chair Powell's speech later this week. With no domestic cues, he is expecting the 10-year benchmark bond yield to trade in a range of between 7.2 to 7.26% for the day.
Well, we have a lot of stock-specific action that we're going to be tracking for you. We get to that in a bit. But for the time being, we run you through what we're focusing on in our top 10 segment. We're looking at Union Bank, Shriram Properties, Glenmark Pharma, L&T Tech, Brigade Enterprises, Adani Enterprises, REITs, Ramkrishna Forgings, as well as Lemon Tree. All of them will be reacting to positive news flow. We're expecting a large trade on SJS. So we'll keep an eye on that one, likely to open up in the red.